Yeah, so what I thought we'd do today, and I know Amir kind of prepped you for this, but I'm going to share the internal model. And really, I think, what's best, I'm really just going to walk you through it because I think everyone sets up their models a little bit differently. Kind of show you how we have everything set up, kind of go through some of the areas of this specific deal where I think there's some risk or where we're being conservative or aggressive and kind of talk through the process. And then happy to answer any questions you have too. So here's our model. So you'll notice that the way that this is set up is you have this summary page, and this is really going to encompass all of these other tabs, all of the things that they represent kind of push to the summary page so you can kind of go over it in one quick overview. And then all the tabs get a little bit more granular. So you'll have a sample investment of what a $100,000 investment will look like, the annual cash flow tab, which we're going to jump into that as we go through this to kind of explain out all the different pieces of the deal. And then you have our internal underwriting and modeling, the trailing 12, which is just the previous 12 months of financials from the seller, our CapEx and interior renovation schedule, and then the actual rent roll. And Red IQ and Archer Rent Roll, these are just two softwares that we use that kind of help us, perform additional analyzation. So getting started up here, so you'll notice in box one on the left, you have rudimentary information that is the name of the property, the address, unit count, vintage, and the rentable square feet. And then below you'll have the sources and uses tab. This is pretty mainstream. Debt, equity. We may be using some institutional pref equity. We're in negotiations, but currently right now we don't have any on the deal. But what you'll notice about these two tables is that they're always going to mirror each other. They're showing you where all of the sources are coming from and then what all the sources are being used for. So you have the purchase price, the cost of acquisition, and the money we plan to use to renovate the interiors and the exteriors of the units. And feel free to stop me at any point if you have any
Yeah.
questions.
Yeah, so my first question was going to be on the institutional, equity. It
Mhm.
looks like you're raising all the equity and financing it, yet the kind of institutional is not putting anything in. I mean, what's the thought behind that?
When we set this up originally, we didn't have a pref partner, but I would imagine that we probably will have an institutional pref partner, and they'll probably come in for somewhere between 4 and 5 million. We just don't have that in place yet. So when they come in, this number will be reduced by whatever number the pref comes in for. So the total sources and uses won't change, but you'll have a different source of equity that will reduce the total amount of equity that we're raising from LPs.
Yeah, I mean, I guess when it says institutional up there and I see manager below, y'all are the manager. Is that correct?
Correct. So no one that we partner with will ever be the lead sponsor or have the control over the deal. We always maintain the control and we manage the property. There's a few other players that are involved. So we may have key principals that are folks that either bring capital or bring expertise to the deal and they get a share of the general partnership, but they won't ever be able to have decision-making control. And same thing with institutional pref equity. They'll come in and they might have preferred economics for writing a $5 or $10 million check. So you'll see their pricing is usually down here. So typically, this is a little bit low for where pref equity is right now, but pref equity right now would probably be priced somewhere between 12 and 14% all in with a current pay of 6%. So the reason that we can't use a large amount of pref, like say we'd want to put a $10 million pref slice into this and only raise $10 million of capital from LPs, they're going to be taking a pretty high current 5%, whereas our model is showing that the property will support in year one about a 4% current pay. So when you take someone in that has a higher current pay than what the deal supports, you hurt the cash flow for all the other folks. So there'll be a limit, just like we have a Class A slice in this deal, which is also limited. So Class A, you'll notice, is only 10% of the total capital stack. And the reason Class A is so small is because Class A investors are getting 10% paid current.
Yeah. And do y'all, as a manager, I mean, do y'all ever invest in your deals or are you
Oh
only
yeah. Yeah.
okay?
So we put usually at least 10% of the total amount of equity raise. So in this deal, we'll have about $2 million in the deal, and that'll be made up from Vic and Ravi's personal investments. And then we usually have some key principals that put at-risk capital in our deals that have put, they've been co-sponsors with us on, 10 plus deals.
Okay, so we're saying manager equity, y'all's partners essentially put an individual so that it doesn't show up in that percentage. I'm looking at row 18, right?
So this
You're
would
showing
be, yeah, this would be manager equity class B GP. It would be it's zeroed out, but we'll have the GP will be at least $2 million into the deal.
okay.
And that will reduce this amount to 10 million. And so moving forward, this equity breakdown, we've kind of jumped ahead a little bit, but basically this really the purpose of this and in this internal model is kind of lining out exactly how much of each class we anticipate the capital stack resembling. So you have A, B, and reserve class, which is the C class. The reason that you have, we explained the 10%. So, we're constrained by cash flow on how much Class A we can bring in. Usually the project can support a little bit more than 10%, but we like to be conservative there. Reserve class could grow. This is usually based off of how many of our really large investors come into the deal. Viking likes to limit reserve class to 25% because it keeps more of the profits. Reserve class gets an additional 10% profit split that comes directly from Viking profits. So while this is 25%, there is flexibility here. It's just it needs to have Vikram and Ravi's support, and they have to be willing to give up that additional upside to allow me to go past 25%.
Okay.
And then this will be updated if we use pref. But like I said, the pricing is usually a little bit higher than this. Purchase price metrics, you have the agreed upon purchase price with the seller. You have their trailing 12 NOI. And then you have the formula, which is their NOI versus their purchase price into a cap rate. So this would be our going in cap rate. We're buying the property at a 4.92% cap rate. And the reason that this is important is as we go to the annual cash flow tab, the whole premise for one of these deals is buying at a particular cap rate over the course of the hold period, increasing net operating income, and then targeting an exit cap. And the projected NOI versus the projected exit cap is what's going to give you the assumption for the sale price. And that's where most of the forced appreciation happens, which is, the basis for almost all of these multifamily acquisition deals. I mean, this is probably a good time to jump into the annual cash flow tab to kind of show you that lined out. So what you have here is you have the gross potential income, which if you remember in box one, we saw the rentable square footage. This anticipates that at these effective rents, if every one of those square feet was rented out, this is the total amount of money the property would produce at any one given year. Underneath, you have all of your assumptions when it comes to losses of revenue. And you're going to have loss to lease, you're going to have vacancy, you're going to have concessions, models, office and employee units, and bad debt. Loss to lease is going to be the time in between tenants. So think somebody agrees to move out, they leave, and it takes 2 weeks for a new renter to come in. We're refurbishing that unit and getting the new renter in. Every day that property is not occupied, it's a loss of revenue. So it has to be accounted for. Vacancy is more, obvious. Any unit that goes more than a 2-3 week period is going to affect your vacancy numbers. Concessions are just going to be, the promotions that you run in order to entice renters to come in if you're trying to either lease up or if you're trying to increase occupancy. This one's pretty obvious. These are just deals or lost revenue due to a model unit. And then bad debt's an important one because this is the lost revenue to someone that's in a lease that's showing occupancy. So they're not hurting your vacancy numbers, but they're delinquent in their rents. And I think this is an important one to show because a lot of times you'll see properties are 93% rented, 95% rented, but they might be carrying some level of bad debt. And you'll especially see this in properties in areas where it's very hard to evict tenants. They'll have really great occupancy, but they might be carrying $80,000 of bad debt and they have to get that off of their balance sheet and that affects cash flow. So flipping back to the summary page, just after we talk to these, this is where you see the assumptions that we're making for those revenue loss tag items. And you can see them kind of lined out for each year of the potential hold period. I think this one's a 5-year hold. We're either going to go with 5 or 7-year debt, but I think the plan is to get out of this property somewhere between years 4 and 5. And I think, this would be a good spot to kind of talk about one of the areas where I think that this particular deal has a soft spot. And there's some additional risk that, for instance, the deal that we just closed, the one in Atlanta, didn't have the same risk. So the property that we bought in Atlanta that we just closed on was a late 90s property. It was built in an area called Dawsonville, which is about 40 miles outside of Atlanta. And it was the only affordable apartment complex in an area surrounded by Class A properties that were built over the last 4 or 5 years. So it was 95% occupancy. There wasn't a lot of new supply coming online, and there wasn't much risk to vacancy, and there wasn't much absorption risk because there was a huge shortage of supply in the area. New Braunfels, which is between Austin, well, you live in the area, so it's between Austin and San Antonio. But one of the things that presents a short-term risk in New Braunfels is there's a lot of supply that's come online recently,
Yep.
and really, I think to kind of break down why that's happened, if you don't already know, is debt was extremely cheap in 2017, 2018, 2019, 2020, and variable debt especially was very cheap due to a zeroed out federal funds rate. So what that created was an opportunity for developers to get really great short-term loans and develop properties. So when you look at our investment summary, you can see on the comps that there's probably 3 or 4 properties in the close vicinity that were brought online between 2021 and 2024. So the reason that this presents a short-term risk is that area has to now absorb all of that new product that's come online. And every developer that has put a deal together has planned and budgeted for a pretty healthy amount of concessions. So what ends up happening when you have a 2012 property that's competing with a 2021 or a 2022 property that is offering 2 months free is it's harder to keep your property fully occupied and compete with a brand new property with similar rents. Now, the reason that this is a short-term risk and not a long-term risk is because the other thing that we track is where permitting and development is tracking from now through the whole period. So while there is new supply that's come online, that's being absorbed, that's 50% leased up, you have no new developments coming online over the next 3 years. And with the federal funds rate at 5.5%, almost all development has ceased because now bridge debt and mezz debt that developers use to construct these new properties has dried up, and it's really hard to get a development deal done in this time. So what this does to our model is and I think it's fair to tell, investors that are coming into this deal that there's a little bit of extra risk in this when it comes to early year 1, 2, and 3 cash flow. So there might be a month where occupancy dips from 93% to 89%, and that would need to be expected. And you'd have to know that going in, that there's a little bit of extra risk there. So you'll notice it, and if you've looked at any of our other models, we typically have this at 5% vacancy, and we usually keep all of our properties at around 95%. If they go higher than 95% occupied, what that tells us is that we're not charging enough for rent. If they go too far low, that means that we might have to lower rent or offer concessions to get them up. This one, we're dropping it 200 basis points, 2 percentage points to account for the fact that it's unlikely that we're going to be able to keep this property at 95% over the first couple of years. And we trail this down in year 4 and year 5, because that's when we feel like conservatively we're no longer going to have to deal with some of these other groups. Because at the end of the day, any of the people that built between 2020 and 2021 paid $225,000 a unit to construct. So the upside that this deal has that deal doesn't, those deals don't have, is that we're able to buy this newer property that was built in 2012 for $148,000 a unit. And one thing that isn't incorporated into this model, and we haven't announced yet, is due to the fluctuating 10-year treasury ticking up, we were actually able to negotiate with the seller an additional $500,000 decrease in price. So the sales price is actually $36,850,000 or something like that. So it's slightly less per unit. Any questions there? I know we kind of covered a bunch.
Yeah, no, I think you hit on one of the things that was wanting to understand was kind of strategy and new buildings that were coming up, right? I actually lived in this place for 4 months when I was relocated from Dallas.
This particular property?
This particular property.
Oh wow.
So
What kind of feedback can you give me? I haven't been yet. I'm going this weekend.
yeah, no, I mean, New Braunfels is a fantastic city, growing fast. The downside to this one, I would say, is its location compared to others.
Hmm.
Like, it's close to things because everything in New Braunfels is close. But it's not the closeness of like, hey, I can kind of walk to a couple restaurants and stuff, which a lot of these other ones do have that you're comparing yourselves to. It's got a nice, you've probably seen the pictures. I mean, it's got a nice walkway around a little lake over
Yeah.
there. It's 5 minutes to drive anywhere that you want to go. So again, close. But like if I was the same price location, I want to pick Sundance over the other ones, right? And so
Mhm.
to me, it's gonna be a question of what do you do to differentiate yourself? You're charging the exact same rate as everyone else. I'm gonna go live with the other one because I know the development that's going on in New Braunfels. If it's slightly cheaper, yeah, I would pick there because it's not far enough away, right, to impact me.
Yeah.
To me, that's the one downside with this place is going to be location compared to your competitors.
Right. Okay, great. Well, I'm excited. I'm planning on going to the property this coming Saturday and kind of going and looking at all of the comps and kind of driving the area. So I'll definitely keep that in mind.
Yeah.
So, well, that's cool that you actually lived on site. What did you think as far as as being a renter there? Was the property pretty nice? Was this
Yeah.
was
This
it
is
a
back
property when you lived there?
It was in 2017.
5 years
I was
ago.
there like on a corporate lease, so I had had a furnished unit for 4 months, right? So it wasn't coming in, but it worked well. I mean, I thought it was in decent condition. They have a really nice pool. We enjoyed the walking spot that they had there. So I think I can't remember the gym. It's been too long, but there's nothing about it. I don't remember ever being like, man, this is not a good spot. Like I enjoyed living there. Kind of worked for what I needed. Is furnished well,
Yeah.
and all those things.
I think that's really the play is it's going to trail a lot of the newer properties that are there that are built. I think when you look at the comp summary, it's already, trailing some of those. And it's pretty well occupied. I think it's at 94, 95% right now. We just know that with all of the new supply, it has to be a risk that's taken into consideration. Okay, so I'm going to jump back onto the annual cash flow tab and kind of show you what we're thinking as far as the rest of this down into NOI. So essentially, once you get through all of those revenue loss generators, you have some other income that could be additional rents that are charged for rental washer and dryers, private yards, garages, things like that. And that gets you your total net income. Then you have all of the expected expenses, which, real estate taxes, insurance, utilities, management fees, repair and maintenance. So once you get through that, you're left with your debt service. So this is another area that I really like to focus on, especially with folks that aren't experienced in investing in these types of investments. It sounds like you probably are, but a lot of folks ask me, what would really have to happen in order for me to lose my principal and lose any hope of a return, and this just totally being an awful experience. And the easiest way for that to happen, almost the only way for that to happen outside of fraud, is the sponsor not paying their debt service. And the way that you look at a Proforma and measure the risk in a sponsor being able to pay or not pay its debt service is by looking at the debt service coverage ratio. So typically, a red flag DSCR is going to be about 1.25. And the reason that is considered the benchmark is the agencies, Freddie and Fannie, that's usually their benchmark on whether they're going to act as the largest investor in one of these deals and provide the debt. So when they're providing a $20 or $25 million loan, a few things that you can bank on Freddie and Fannie doing are ensuring that the property isn't DSCR constrained and having that 1.25 base. So you want to see some kind of spread above that. We like 1.5 and up. And typically our average DSCR is going to be closer to 1.8. And then the other thing that you can take solace in is when a sponsor is using agency debt, they're not predatory. So they're not hoping that you fail so they can take the property, wipe out all your equity, and get the property for pennies on the dollar. That's not the way they're set up. And B, because they're investing such a large amount of this money onto a non-recourse loan, they put a lot of time and effort into due diligence and vetting out of the sponsor. So our principals and company have to provide them personal financial statements. They have to provide them an SREO that incorporates every property that we own, how much debt is on every property, what the NOI is on every property. So while a lot of folks don't have the opportunity to do a very intense deep dive and due diligence like the agencies do on us, the agencies do have pretty high standards when they're picking which sponsors they'll work with and won't work with. And in this environment we're in, where a lot of multifamily sponsors weren't using agencies and were using debt that's primarily used for constructing properties, the agencies are even more careful. So now they also, in addition to want to see your credit worthiness, your personal financial statements, and all of this information on the properties you own, they also want to see that you don't have a bunch of exposure to properties with debt funds and other lenders with variable debt, to where if one property in your portfolio goes under, that it's going to affect this investment that they're making. So I would recommend, as you look at deals, to really focus on what DSCR is, which is, this ratio is really just showing the amount of cash flow you have commensurate with how much you owe the lender in your debt service. And 1.63 represents, you can make one full debt service payment and then you have 63% of another full debt service payment. Year one is always going to be the riskiest year, because that's when you're taking over the property, you're putting in a new property management company, and you usually have some level of bad debt and delinquency that filters in because sellers are incentivized to promote that they have high occupancy. And a lot of times what ends up happening is they relax their renting standards. So we always just assume that we're going to run into a little bit of bad debt in the first 6 months. But you'll notice that as things trail out, the DCR will spike up in most other years. Year three, you see a little bit of a dip back to the mean. And the reason for this is because the agency loan that we're going to get through Freddie has 3 years of interest only. So for the first 2 years, you're not fully amortizing, which you can see here, the principal's at zero. You're only paying interest. And then when you get to year three, you're paying interest and you're fully amortizing. So that drops DSCR down a little bit back to here. But you've also grown NOI about $500,000 over that time, which is nice. And then you keep elevating NOI through year five and beyond. And as you get to year five and beyond, you see the debt service is nearer to 2. The other thing that can affect your debt service coverage ratio is the amount of proceeds that you get. So one of the things that I think a lot of sponsors don't love about today's real estate market is debt lenders are only giving about 60 to 65% leverage. Whereas in 2020, 2021, 2022, it was very easy to lever a project up to 80% and above. Now, sponsors like that because debt is usually cheaper than equity. The returns that you're expecting aren't going to be the 5.75% that Freddie Mac is expecting. So the more equity you have in a deal, the lower the returns are for everyone. And the debt is a nice way to really provide great returns for your investors. Now, the problem with that is the more you lever a property up, the lower your DSCR goes. So you're getting a higher return, but you're taking on more risk. So in this environment, just inherently with the way that the agencies are lending, they're de-risking the investment for investors. And even though it would be nice to have higher proceeds, I think this is a good environment to be investing in because you're still getting pretty good risk-adjusted returns, but you're not dealing with really highly levered deals. And then, of course, this deal is using fixed agency debt. So the other big thing you're going to want to make sure when you figure out who the debt's through, what the DSCR is, and where the spread is between NOI and how much you have to pay in debt service is if the loan is fixed or variable, which I'm sure I'm not telling you anything you don't know, but you would be surprised at how many investors over the last few years didn't ask these types of questions and the sponsors didn't really offer the information up. So variable debt could allow you to show a DSCR that looks really attractive, but then when something happens like, a federal funds rate gets raised by 550 basis points in 6 months, which is unprecedented, you have variable rate loans that at the moment when these sponsors bought these deals made a ton of sense. You avoided a prepayment penalty, you got really high leverage, and rates were incredibly low, turned these deals upside down in a matter of 6 months, where, they may not be able to pay their debt service payments. And then in addition to that, they could lose the deal because a lot of the folks that provided bridge loans were a little bit more predatory. So they were almost, hoping that folks failed so they could take the properties for just the debt amount. So I think that piece is one of the things when I do these that I really like to hammer home is as a risk profile is DSCR. The other piece here is we talked about net operating income and how it trails up. So this is the other big, I'd say, business thesis for these deals is you're buying at nearly a five cap. You're usually planning on selling depending on what you believe is going to happen in the real estate market. So if we were dealing with a very low cap rate, we would usually anticipate selling at probably 50 basis points of expansion. In this environment, we're assuming that over the next 5 years that cap rates are going to compress based off of interest rates coming down. So that's something that when you see the spread between the going in cap rate and the exit cap rate, that's another kind of risk indicator. And you as the investor have to agree with that thesis. Or if you don't agree with it, look at the sensitivity table and figure out what you think the exit cap would be, and then kind of make a judgment on whether you're with us on us being realistic or if you think we're being aggressive. But that's another thing I really like to point out. So with what we have projected, and I'll show you the spread after this, based off of this net NOI increase, 3 or 5, you can see down here the increases in sale value. So it goes from a $45 million valuation in year 1 to in year 5, this is how you get an additional $19 million of value. And this is based off of a going in cap rate of, I think with the $500,000 discount, you're looking at right around a 5 cap, probably like 4.98. And then we're projecting exiting at a 5 cap. So we're not projecting cap rate compression on this one. We're projecting, we feel like we're being conservative by saying that we'll be able to sell this at what we're buying at a discount in a market where most values are down due to extreme cap rate compression. I'd say about 150 basis points is what most people feel like deals are compressed by. But if you were looking at another deal, or if I had come to you and said, oh yeah, well, these numbers look great. We're buying at a 5 cap and we're going to sell at a 4 cap. At that point, you have to ask yourself, like, wow, that's like pretty aggressive, right? Like you're willing to buy this at a 5 cap and maybe you think things get better, but banking returns on 100 basis points of compression would be pretty aggressive, for me. So based off of that NOI growth, and so one of the other things about this deal compared to other types of deals, and I don't know if you had a chance to watch the webinar, but this would be considered at a 2012 property. I mean, you've been on site, you've seen it's a nicer property, competes pretty nicely with some of the newer product. Yeah. This is considered more of a core plus asset. There will be, I think we've lined out in our CapEx budget about $5,000 per unit to upgrade the units over time. But that's going to be remedial lighting packages, really slight like Nest thermostats, things that are like very small upgrades per unit. So the amount of rent growth that we plan to get through the business plan is minimal. Something like $75 per unit when we spend $5,000. That provides a little bit less risk than a property like this previous one that we closed in Atlanta, where the whole business plan was predicated on taking a 1998 property, spending $17,000 per unit and getting a $300 rent bump. And the reason that it's less risk is in order for that to ring true, we have to complete the upgrades at the price we predict, 17,000. And then we also have to capture that $300 price increase. And if we don't, it skews all the numbers. So when you're dealing with a property that you're not doing a huge value add plan, the reward in many times might be a little bit lower because you're taking less risk, but you're also taking less risk. So less things need to happen in order to get to the returns that you're projecting. Let's see. Okay, so I wanted to go, while we do that, I want to go back here. So this is basically the renovation budget. So you can see we plan to start renovations in month 19. So you're looking at nearly 2 years before we even consider starting renovations. And the way that we do that is we usually do 1 or 2. And if we capture the $100 premium that we're planning, we'll continue to do that. And it's usually 7 per month on a light value add. And we plan to do it to all 252 units. So you should know that part of this return structure that we're projecting is capturing this $100 rent premium. If we do these and we don't capture a $100 rent premium, then that would affect the returns. It would affect the NOI growth. Now, if New Braunfels gets hot again and a lot of these newer properties run through their concessions and at the price point that they built at, they have to increase their rents, and we're able to capture $100 or $150 of rent growth without doing these renovations, there's also a case to be made that we don't do any renovations. We capture whatever rent growth we can organically, And we save this for when we sell the property to entice a buyer to pay more when they're building their model to say that we kind of left a certain amount of meat on the bone for the property to now have a more intense value add to compete with product that's being built in 28, 29. And maybe it's a $15,000 upgrade for a $250 rent bump. And we're able to get a higher price because as people are building their model, they can justify it. So that's important to understand. We talked about the debt, but this is kind of the pre-loan assumptions that we're making based off of our discussions with Freddie. And we're going to be, an interest rate of about 5.7. This does include a pretty significant buy down of, I believe it's, almost $1 million buy down. I believe it's 3 years of IO, not 24 months, and it'd be of about 64%. This would be the current loan amount, but this usually will stay pretty flexible. It won't change too much, but it will. What we're usually trying to do is figure out as we look at the real estate cycle and what the Fed's doing, if we think that the 10-year Treasury is going to continue to go up or if it's going to decrease over the next 45 days until we close. So we could rate lock today and get whatever the quote is today, or we can kind of gamble and say we think 30 days from now we're going to get a better interest rate. Because if the 10-year trails down and we're able to secure a better interest rate or a better situation, it usually also will increase proceeds, which will exponentially help the deal. So I think our method of thinking right now is that it doesn't make sense to rate lock, but that could change. So the loan term is going to be flexible probably for the next couple weeks, and that could change on a dime if Powell comes out tomorrow during his meeting and says, we're definitely not cutting interest rates this year and we're considering raising interest rates this year, we probably rate lock tomorrow. So that's something to also just kind of keep in mind as a potential risk for the next 30, 45 days is we can't really control what the market's going to do. And while we are trying to time the market and get the best interest rate on the loan, it is a little bit fluid until closing. Okay, so we talked about that. Revenue and expenses. These are our internal metrics. So this is the organic, so revenue due to organic rent growth. This is what we've usually put in our model is 3%. There could be an argument made that rent growth would go under 3%. Typically, it pegs to inflation. Inflation might get under 3%. That's the Fed's goal. Unlikely to truly be sub 3%. We tend to stick with the market. Even a year and a half, 2 years ago, when at the property level we saw 10% rent growth, our model still said 3% because usually things, no matter which way they go up or they go down, they usually revert to and normalize to what is reasonable. And a 3% inflation rate is typically, we're typically not going to be below that. Expense ratios is based off of all the other 26 properties that we've managed. We run a pretty tight expense ratio. And you can see, like I can send you this model too that you can kind of play around with and look at your convenience that I'm not controlling. But we do go out and get updated quotes. So insurance is based off of active quotes that we have right now. These are up-to-date numbers. Real estate taxes take into account what they've been paying and the new sales price that we're buying at and what we think those will go up to. So this is all, pretty real-time data.
And Amir actually sent me this, so I was able to kind of look at it before our call with questions. The real estate taxes you had dropping from the trailing 12 to the Proforma, essentially. So what was y'all's analysis? I think the taxes actually go down on this property.
Usually if they come down from the trailing 12, it is due to a petition to reduce the amount. So I'll talk to our underwriting team and find out what the thought process there is and get back to you. But that's usually it's usually a kind of a rebate and an argument that's made to the municipality to reduce the real estate taxes in year one.
Okay. And then do you know on the repairs and maintenance, that was another one that seemed like a fairly significant decrease over trailing 12. Was there anything like any large repairs that they've made?
I think they've done the majority of exterior renovations, exterior CapEx. So the majority that we have in repairs and maintenance is just kind of rudimentary things that we have in there. Plus, you wouldn't see any of the CapEx budget here. So, so you'll notice we'll usually look at what they're doing And then we'll look at what we're doing on our other properties in the area. We had a property in Austin that we've sold. We have one in San Antonio. We have one in Houston. And we'll use kind of some of our historical data along with what they're doing. And our goal is to come in and do a better job than they were doing. And it's usually a blend between the two of what our historical data says and what their historical data says.
And so y'all manage the sites yourselves. You have an internal management team for the properties, and is it just a flat management fee for every site? How does that work?
Correct. So there's a 3% property management fee. We're not vertically integrated, so we don't have an in-house management company that's separate from Viking that manages these properties. We asset manage the properties, and we have an asset management vertical within our company, and we work with one property management company.
Okay.
So that group is called First Community Management. They're headquartered in Atlanta, and they were just recently acquired by Asset Living, which is a really, really big property management company. But what's nice about that group is because they manage the 16 active properties that we have exclusively, that they've actually built a team within their team that manages only our properties. So it's not a team that's spread amongst a bunch of sponsors. They own their sole focus is Viking properties, which is nice. And then our asset manager has a construction background. So we actually do all of the construction management in-house. We don't allow our property management group to do that.
Okay.
So let's see. Okay, so I think we covered most of this, the renovations. As we get through to this side, so we can talk about fees. And some fees are going to be pass-through fees. Some fees are income generating fees for Viking. So let me line those out for you. Closing costs, management fee, pass-through fees. Reserves per unit are just what it says. These are amounts of money that are put aside in the event that units need repair. Disposition fee is to Viking, and the refinance fee is a loan origination fee in the event of a refinance. Would basically be the closing costs. You also have an acquisition fee. That's a Viking fee that is an income generator for us. And then you also have a asset management fee, which is over here, which is 2%. So the disposition fee and the acquisition fee are of the sales price and the purchase price, respectively. The asset management fee is a little bit different. This is based off of the total amount of equity, and it is not all taken current. So 1% of this fee will be taken current, and 1% will be paid on the back end when we dispose of the deal to protect cash flow.
Okay. So it's kind of like an in from the preferred's getting paid out, but it's just done differently. Okay. That makes sense.
Yep, exactly. So you have refinance assumptions, but I don't think that this deal is one that we're probably looking to refinance. However, you never know. In 3 years, if we're looking at a much better debt environment and the property is doing really well, there might be an argument to be made to either recapitalize a deal or do a refi. But I don't think that holding this property for more than 7 years would make a ton of sense. And then the return metrics are all based off of these exit assumptions. So you have the exit cap, you have the NOI that we went over in the annual cash flow tab. You have the closing costs. So you have the sale price. It's based off of that exit cap rate and NOI. You have the new sales price per door, which is about $107,000 spread above what we got at the basis that we purchased at. You have the cost of sale, which includes our disposition fee. You have the loan repayment, which is, with those 2 years or 3 years of interest only, you'll have an amount of the loan that's due. And then what's left is your net proceeds. And these net proceeds basically go through the waterfall, which is, for Class A, that they're capped at that 10% return. Most of that will be given to them over the hold period, and they'll be getting the return of principal back. Class B investors will be getting caught up. So at disposition, you have to catch up any pref that isn't paid to A, then B and C together, they're pari passu. So for instance, in this deal, I think cash flow is projected in year 1 to be at 4%, year 2 to be at 5%, and then it's 6, 6, 7. So if you're in B and you're earning a 7% pref, you're not necessarily getting that annually, but you're accruing the difference. And at disposition, before any of the money goes to the waterfall, you get caught up to that 7%. So the pref is really kind of a protection mechanism to make sure that you're getting caught up to at least that amount prior to Viking getting any of its profits. Other things to note are there
So
is, oh, go ahead.
on the class A, so is it essentially as long as there's enough cash flow each year, the 10% will be paid out, or are y'all assuming paying a lower percentage
So
year than?
the way that we model this out is that the property produces enough cash flow to pay the $2 million of Class A, their 10% over the whole period.
Okay.
Now, if there's some kind of adversity at the property, like say we run into, like we discussed, short-term vacancy or some kind of cash flow impediment, a fire at one of the buildings, something goes wrong. Class A isn't guaranteed to get 10%. They could get nothing. They could get 5%. These types of things may happen due to if the property has available cash flow. It's only going to spit off what it has. But the prioritization that Class A has means that Class A has to be made whole before B and C can get anything. So if there's a situation where Class A is only getting 8%, that means B and C are getting nothing. And when we are able to pay distributions to all classes, Class A has to be completely made whole before B and C can receive anything towards their pref. But you can see that the cash on cash, the average cash on cash over the whole period is around 5%. So it's gonna, trail up. And these are all also projections. So we could exceed these projections, but more than likely Class A will get its 10%. B and C are going to get some spread between, 3 and 4 versus the 7 or 8% pref that they're accruing. And then at disposition, they get the full catch up. And then it goes into the waterfall where your 70% of the profits are going to B investors. And then C investors are getting the same 70%, plus they're capturing an additional 10% from Viking's side. So
Okay.
Viking's 20 instead of 30.
And did this deal pay out monthly, quarterly? What's the
Monthly. So
monthly?
all of the Viking products do monthly distributions with the exception of the Hyro fund. The Hyro fund is a pref equity fund, and that one pays quarterly.
Okay.
But you can see really where this kind of represents the middle of our range. So when you look at our marketing, I think it's, 1.8 to 2x. These will get slightly better with the $500,000 discount that we negotiated in, but you're looking at, mid 14s IRR, mid 15s, close to 16 for reserve with a decent equity multiple and a decent average annual return.
What have your past deals typically been? Like, what's the typical IRR been on those? This one seems a little lower than I've seen, but I also know that the market's changed a lot.
Yeah. Well, and this one's a little bit lower, also due to it not being a really intense value add. So, like if you're looking at the Atlanta deal where we were creating a really big rent increase by doing that value add plan, it's a little bit more risk, but the IRRs were closer to 16 for B and almost 17 for C. And you had a 2x equity multiple for B and higher than a 2x equity multiple for C. This one takes a little bit of a hit because there isn't an extreme value add, but you are buying a newer core plus property. If you look at our 9 exits, our average annual return is in the mid 20s and our IRRs are probably up in the 18s. But I always like to caution people. You have to look at people's track record, and we love that our track record looks so healthy. But a lot of that had to do with timing. So we were very fortunate to buy in 2016 and 2017 and exit in 2020 and 2021. You saw an insane amount of cap rate compression that nobody expected. And we were able to exit deals at 2.5, 3x multiples that we didn't underwrite that way. So our historical track record looks fantastic, but my gut's telling me that these deals we always try to exceed our expectations and under promise and over deliver, but I don't think we're going to get into a situation where in 26, 27, 28, 29, where we're looking at exiting some of these deals, that we're looking at selling deals at a sub 4 cap. And that's what we were seeing in 2021 and 2022.
Okay.
So just realistic expectations, I think, are always the best. I think that these types of deals, when you're looking at a 2012 property with conservative underwriting, if you can get, a 1.7 to a 1.9x return in B with a hope of overachieving, we try to provide folks, singles and doubles that could overperform and try not to pitch, grand slams that may or may not materialize.
Got it.
Let's see. Any other questions on any of this that we've gone over?
No, I think you hit most of my questions. It'd be helpful if you could, I might follow up with just the real estate one to understand kind of, it seemed like a significant decrease there.
Oh, the
The
real estate.
taxes. Yeah, sorry
Yeah.
about, yeah,
So
real estate taxes.
I'll check with the underwriting team and get back to you on that one.
Okay.
So amazing. Yeah. I mean, I think this deal, if you had to, and you're pretty familiar with the area, I think the reason that this deal works in this market is the basis that we're buying it at. You know, it's
Yeah.
you don't see very many opportunities to buy things at 100 and sub 150,000 a door. Pricing in the reduction in price is, going to help that a tad. And it's really just, while if you look at our track record and where the deals that we've invested in over the last few years have been, they've all been in Houston, in Austin, in San Antonio, in Atlanta. And what we're finding is if you kind of sneak out into the path of progress and you look in areas like New Braunfels and you look in areas like Dawsonville in Georgia, there's areas that are really easy to locate because institutions have started developing significant amount of product there. And if you can go there and buy at a really reasonable basis and then trail those newer properties by a few $100s in rent, it's really an easy business plan to follow.
Yeah, that makes sense. And when is it end of May that y'all are looking to fund?
Yeah,
Fund
so as far as timeline goes, our closing is, I think, for the first week of June. So probably last week of May, we'll request, like kind of last call for funds to come in. It's always our preference to get them as soon as possible, but usually the funding deadline is going to be about 2 to 3 weeks before our anticipated close, which I think is scheduled right
Okay.
now for June 7th.
Okay. And do you have each class open, like class A
Yeah,
and class
so
G?
where we're at today is Class A has about $1.1 million funded. So there's about $800,000 left of Class A. Reserve class has about 3 million funded. So there's about $2 million left in reserve. And then Class B has like 7 or 8 million available. And that's assuming that we don't have pref. If pref comes in for 4 to 5 million, that would be reducing Class B.
Okay. And then you said the partners also, like when they put their money in, that goes into class B.
Correct. It's always,
Right.
yeah. They take normal economics on B. And occasionally, depending on which investors that are kind of our long key principal type investors that are really, I mean, at this point, those are the folks that, probably have somewhere between $7 and $15 million with us across assets. We allow them to come into the GP and they make up a portion of that 10% of the total equity. And
Okay.
and they usually sit in reserve class.
Okay. Well, I think that was all my questions. So this is helpful to walk through this,
Yeah.
understand y'all's thought process and everything.
Yeah, absolutely. I think that these are really helpful. And I mean, I could tell from chatting with you that you understand a lot of this at a high level, but a lot of the folks that we chat with, we might be talking to someone that it's their first investment. So a lot of times, and if you don't mind, I'd love to have permission to share this with folks so they could use it kind of as an educational tool and kind of see the thought process. So I'm not really able to do hundreds of these, and we have about 1,000 investors. So if you don't mind, I'd love to share this with some folks that are a little bit newer.
Yeah, that's fine with me.
Great. And then I know you're in the area. I'm going to be there this weekend. I'd love to either meet you at the property if you've already seen it, but grab coffee, drinks, dinner, whatever you have time for.
You're coming in, I think you said you're coming in Saturday, Sunday, or what's your...
Yeah, my wife and I are flying in Friday evening, and then we plan to go to the property Saturday morning. We're actually going to be staying in Austin, and
Okay.
we're in town through Monday evening. So Friday evening to Monday evening.
Okay. I'll look at my calendar to chat with my wife. See, I live in San Antonio, so it's about 30 minutes to New Braunfels.
Yeah.
And I can reach back out and let you know if there's a way we can make something work.
Yeah. Well, I mean, I'd love to take you and your wife out for dinner or lunch. My wife will join and we can get to know each other a little bit.
All right. That sounds good.
All right. Awesome. Well, thanks, Trip, for your time. And, if you run into any other questions, I'm going to tell Amir, if he hasn't done so already, to give you my cell phone number and we can communicate on meeting up that way. And if you have any other questions, feel free to just shoot me a text. We can jump on a phone and chat through it.
Yeah, no, that sounds good. And if you have any questions about New Braunfels or the market, I'm the chief strategy officer over 10 hospitals in Texas, and New Braunfels is one of my markets. So I know demographics, economics and all that stuff. So happy to provide my insights.
Yeah, one thing, since you were actually living on site for a few months, is the demographic at a property like this. Do you think it's made up of what? Like what was your average tenant? Was it a lot of folks like you that were there kind of on like a corporate type of lease?
No, when I was there, it didn't seem to be, it seemed to be a lot of, mid 20s, early 30s with a couple families. That seemed to kind of what made it up. Just like everywhere. I mean, New Braunfels has gotten fairly expensive to live within the proper New Braunfels. So I think a lot of people who are looking to buy houses, it's a little bit more challenging than it used to be. So you're having those families and just so many companies are coming down there, from an affordability standpoint. And then you do have a lot of people building houses in New Braunfels. And so there were several people I met that were renting until their house was built. So I did meet quite a few people who it'd be interesting to see what their data says as far as like term, right? And several people they're like the 6 month, 8 month, whatever, but it
Yeah.
correlated to them building a house. It wasn't like me who was just corporate coming down and got to find a house and everything. They planned to be there while they built the house.
Oh, that makes a ton of sense. And is the single family home market there like pretty robust too? Like are a lot of folks moving out that way and commuting to San Antonio?
Yes, and commuting to Austin.
Oh, okay. So you do see commuting both. I saw that Austin's a little bit farther, but it seems like it's relatively equidistant.
San Antonio's closer for sure, but I think when you look at your options of where you want to live, like if you don't want to pay the Austin rates and you come down, New Braunfels is nicer than San Marcos, and so some people just come down a little bit further. It's about 15 minutes more. You'll see it when you come down here, but yeah, most people go San Antonio versus Austin, but you still have that Austin people, and I think that's why part of the reason why New Braunfels is growing north,
Yeah.
is because you have the Austin people who don't want to come all the way to the south side of New Braunfels. It's an extra 10 minutes. On the north side, which is where this one is, it's a faster trek to getting to Austin.
And is the hospital system that you manage, are they like looking at this as the like that these two like Austin and San Antonio are pretty much going to grow into each other? Like is there a
Yeah.
growth trajectory for your hospital group that is kind of tracking this kind of information too?
Yeah, we're not in Austin, so we hope it doesn't happen because it's more Austin coming down to our market. But we know that it's going to happen. You're seeing San Marcos, New Braunfels. They've been the fastest growing markets over the past 10 years between San Marcos and New Braunfels. One of them is in the top 5 every year. And they've been number 1 2 or 3 times. And our hospitals across the highway from its location near the Buc-ee's. And when you look at growth numbers, it's not a matter of are the patients there. It's a matter of how do we get the specialists to actually take care of them all, because all the patients are coming is growing. And so it's one of our busier ERs.
Awesome. Well, yeah, I hope we get a chance to meet. I think I can learn a lot from you about this area. All right. Thanks, Trip. Have a good one.
You too. Thanks.
Bye.
Bye.